Okay, good evening. I hope you can hear me okay. In fact, if I can just ask one or two of you, there's a chat box towards the bottom right-hand screen, and if you could just either say yes, you can hear me, or put a thumbs up sign, just to make sure I'm not talking to myself. So, excellent. Okay, lovely. Thanks, Noel, for the confirmation there. Okay, well, let's get started. It's great to see so many people interested in this particular topic. It is a webinar and seminar that I did about 18 months ago, and it certainly proved very popular and a great deal of interest. So for those of you who don't know me, my name's Richard Lowe. I'm originally from Oxford, England, but I've lived in Asia now for 30 years. The last 28 years have been here in Singapore, although tonight I'm actually in KL, visiting clients up in KL. I hope my and internet connection is strong enough so that we get a good connection and everyone can see and hear the webinar properly. So the topic today, the UK versus SG or Singapore, where is best to invest? And I think right up front, what I want to do is give a definition of what I refer to as an investment property, as opposed to your primary residence where you live. So as we go through this presentation and I speak about an investment property, my definition of an investment property is not your primary residence, but a property that you have invested in to rent out, get a rental yield, and over time, a capital growth. It's unlikely that you'd ever look to live there, and it's just a means to an end in terms of growing your net worth. And so that's the definition we'll be using as an investment property. Now, before we get into the meat and bones of the presentation, what I'd like to do is take stock of what's been happening in the last few years, because it really has been a roller coaster of events and how that's impacted the real estate industry over the last 2 or 3 years. So I'll try and fast forward in terms of a summary, but if we go back to in the UK, the end of 2019, Boris Johnson wins a landslide election for the Conservatives. It looks like then the Brexit has been done, albeit still things to address. Confidence seems to be returning to British politics. Economy seems to be pretty stable and moving forwards. And in the early part of 2020, we did start to see a lot more movement in the real estate market in the UK. And then, of course, COVID hits, and no one expected it, and no investors like big shocks. And it was interesting to see that analysts, once COVID was breaking out, were expecting property prices to fall anywhere between 5 to 7.5% in 2020. Well, how wrong they can be, and unfortunately, how wrong can analysts be on a regular basis? And I'm going to make reference to that a little bit later. But it's been an unprecedented time through COVID, where many countries have seen phenomenal capital growth, which was very unexpected. But for a variety of reasons, people were living or forced to live at home during these lockdowns, and people were reevaluating what did they need from their home. And very often people were saying, well, I need more space. I may need a home office to work from if I'm going to be working either full or part-time from home. If I'm living in an apartment, I really would like to have access to a nice big balcony or a communal garden, or have parkland in easy access to where I'm living. When we couple that with historically low interest rates, and in the UK, a temporary stamp duty holiday, it really was a perfect storm for people to be upgrading, getting larger properties, locking in low interest rates, taking advantage of the stamp duty holiday. And during COVID, of course, the supply of property slowed down. Planning departments were having staff on furloughs. The construction industry were having trouble getting on site, sometimes at reduced capacity, sometimes at zero capacity. So the supply was slowing down, and this has all fueled what we've seen: phenomenal capital growth prices in the UK, and to a certain similar extent here in Singapore. Now, if we go back now 12 months, suddenly the Ukraine war starts. Inflation starts to rise, cost of living increases, and in order to try and curb inflation, one of the main ways that governments do so is to increase interest rates, which has obviously an impact on things like mortgages. And so what we've seen really, especially in the second half of last year, is a slowing down of the market, really because the affordability of mortgages is becoming less affordable. People have less disposable income because the cost of living have gone up. Energy, just one example of that. And so we've going through a time where it's gone from a seller's market towards a buyer's market, purely because there are less buyers in the market, even though the fundamentals of the property market in places like the UK are very strong and sound, as you'll see in some of the data that I present later. So that's really a quick summary of and trying to give some context to what's happened in the real estate industry, particularly in the UK. Now, I'd like to think, having lived over half my life in Asia, and as I mentioned, 28 years in Singapore, I've bought and sold both personal and investment property in both Singapore and in the UK. So I like to think that I can bring the worlds with an understanding of the markets in both countries, and hopefully give you some insight tonight. So let's get started with the presentation. And first of all, I'm just going to go through a bit of data. It is a bit dry, but I'd rather provide you with data so that you can use third-party data to make meaningful assessments of what the market's like. So first slide is a very generic slide. It's created by the Henley Global Group, which are one of the biggest visa and relocation companies in the world. And every year they do a survey based on various criteria you see in the table on the right, effectively vetting best residence by investment for Citi's business index. And London has come out as the top city for best residence by investment. Singapore is a close behind at 4th place. When we look at education, the UK is often seen as a very popular place, very good university institutions, and London is being voted the best city for international students to study in. Singapore, again, a very respectable 17th place as a place for international students to study in. Now, one of the key drivers of the real estate industry, and any industry really, is supply and demand. It's a very basic but fundamental driver of any industry. Now, the UK government has estimated that the need for the number of properties to be supplied each year into the property market is estimated at 300,000. See from the graph here, which goes back to the year 2000, that in no one year have they achieved 300,000 or anything more. In fact, the highest that they've hit was just before COVID at just under 250,000 properties. So every single year, the supply-demand imbalance is actually getting worse rather than better. Now, I mentioned earlier that I've lived in Singapore now for 28 years, and when I arrived in 1995, the exchange rate was approximately 2.6 Singapore dollars to the pound. I remember selling a property in the UK in 2007 when the exchange rate was actually 3.15 Singapore dollars to the pound. Now, this chart here goes back over the last 10 years. And if we're looking at about June 2015, we can see that the exchange rate there was 2.2 Singapore dollars to the pound. And then the Brexit referendum hit, and we've seen a weakening of the pound going down to about 1.7. And at the moment, it's hovering about 1.6. In fact, today's exchange rate was 1.63. So if I take an extreme, 2007 at 3.15, today is just over 1.6. That's almost a 50% swing in the buying power of the Singapore dollar against the pound sterling, which is almost like getting a 50% discount on the purchase of a property, which again is absolutely phenomenal opportunity. And again, when we put this into context, you know, for those people living in Singapore, earning Singapore dollars, it's a very powerful currency to be buying other assets in currencies like the pound sterling. Now, a few other things really just to compare and contrast. So in Singapore, typically you're now finding, unless it's already a freehold piece of land, most of the condo launches will be 99-year leases. The maximum is up to 999. And as I say, there are occasions when there is a piece of land that's freehold. In the UK, the substrata or condominiums typically start from 125-year lease going up to 999. And if you are buying a landed property or a terraced property, these are pretty much all freehold. Singapore doesn't allow leasehold top-up after 99 years, but the UK does allow a top-up of the leasehold. UK ownership via company structure is now easy, quick to set up, cost-effective, with numerous tax and sales advantages. And without going into this point in more detail, in fact, I work with another company that has digitized the ability to buy UK buy-to-let property at a fraction of the cost, a fraction of the time, to make it commercially viable, even for entry-level properties. So again, if people are interested in this area, please let me know, ask questions, and I'll be delighted to help. But that's a complete topic in itself. And maybe I should just highlight at this point in time, if you have any questions, there is a chat box. You might want to sort of jot it down or keep it in mind, because I may cover it at a later date. But please, you know, put your questions or think of those questions in advance. And if I haven't covered them through the presentation, put them into the chat box, and we'll deal with those later. The mortgage options. In the UK, it's one of the few countries that allows interest-only mortgages, whereas here in Singapore, you are basically taking a mortgage which is principal and interest. So obviously with principal and interest, what you're doing is over time, you're paying down your principal loan and you're servicing the interest as well. And at some point in the future, if you hold a property long enough, you're probably going to be paid off the entire mortgage. But the amount that you're servicing each month will be significantly higher monthly repayments, because you are servicing both principal and interest. With an interest-only mortgage, you are purely servicing the interest. You're not any principal. And some people might say, well, isn't that a bit dangerous? I mean, if it is your primary property that you see yourself living in for the rest of your years and retiring in, then I would absolutely advocate that paying off your mortgage so you don't have a burden of a mortgage in your golden years would be essential. But when it comes to an investment property, a property that you are not intending to live in, it's basically an asset that's going to, over time, or should appreciate over time. Most property investors, if there is an interest-only mortgage, will actually take it, because the amount they're servicing each month on the mortgage is significantly lower. It generally means that they have an attractive positive cash flow. They can then decide what they want to do with that positive cash flow each month, whether they are using it for lifestyle, whether they're reinvesting it. And many of the UK mortgagers will say, well, look, even if you're servicing an interest-only mortgage, we will allow you to pay down a percentage of the mortgage each year. And you could always use your accumulation of positive cash flow if you decide you'd like to pay down that principal. But at least in this case, you're now in control of your cash, and you've got that choice of, should I take a principal and interest or an interest-only mortgage? Now, for an investment property, so for those of you who've just come in, this is not somewhere you're living in, it's a second, third, fourth property or so. In the UK, it's very conceivable that you could get a loan to value, whether it's your first, second, third, 10th property, 75% is achievable loan to value. Interest rates have obviously changed significantly in the last year. If we go back about a year, for overseas investors, or rather people who are non-resident in the UK, so although I'm a British passport holder, I live in Singapore, so I'm non-resident. Going back a year or so, getting a mortgage of about 3 to 4% interest rate would be quite reasonable. Today's rates are closer to 5 to up to 8%. Now, if you're buying overseas property in the UK and you take a loan with a British bank, it doesn't impact your TDSR. Here in Singapore, of course, if you're taking a loan with a Singapore bank, whether it's a loan for a Singapore property or a loan for a property in the UK, the bank will assess your TDSR to effectively make sure that you're not over leveraging yourself and putting yourself in a position where you may default on the mortgage. So it's a safety net, but it does restrict how much you can borrow. And one could argue to say is that if you have a property that is providing very good positive cash flow after paying your mortgage, and as long as you have a tenant in place, of course, then there's always some level of risk, but your income is more than enough to be able to service your mortgage, in which case maybe TDSR isn't quite so relevant. Now, in the UK, if you are buying an off-plan property, meaning it's in the process of being built, you can only get a formal mortgage offer by applying typically 3 to 6 months before the completion of the property being built. Here in Singapore, it's normal that at the point that you're applying for or basically reserving an off-plan unit, that you'll actually get a mortgage up front. So that gives you real good peace of mind of being able to have the assurance that you have a mortgage before even signing a sales and purchase agreement. Now, that is a risk in the UK, and I'll always share this with clients, that there is mortgage risk, that if you are investing in a property, and let's say it's 2 years down the road, the developer will ask you to sign a sales and purchase agreement up front, but you could only get a mortgage offer within 3 to 6 months of the completion date. Now, we do work with mortgage brokers. We have an in-house mortgage broker at One Global. And if you wish to get an approval in principle to get some level of comfort, we can do that. Or you can decide, well, I'll only invest in a property that's either completed or close to completion, so I can do the mortgage application and make sure that I've got a mortgage in place before signing a sales and purchase agreement. Now, coming down onto some of those additional bullet points in Singapore. So we've mentioned that in Singapore, you can't get interest only, it's principal and interest. But here's another big point, is that for a Singaporean investing in a second property, the loan to value is reduced down to 45%. And if investing in a third property, the loan to value reduces even further. So you can only get a 35% loan on the value of that property. Interest rates are more attractive, but you have to bear in mind that if you're a Singaporean, you reside in Singapore, and you're investing or buying a property in Singapore, you're seen as a less risky client to the bank because you reside here. Whereas if you are investing in a property in another country, there is an additional layer of risk which is factored in typically to the mortgage, and hence why you tend to find that the mortgage rates will be higher by going and investing in an overseas property. But again, it varies from country to country, but that's the case typically when we compare Singapore and the UK. So I think that covers most of those key points. Again, we work with mortgage brokers. If you have questions, it is a specialized area, it's a regulated area. I may be able to address some of the high-level questions in this area, but again, if it's a question that goes into more detail, what I'll do is I'll bring in a mortgage broker, or I can refer you to one that will be able to address those questions. Now, this was quite interesting when I looked at this data, and the circular pie chart, it shows the proportion of people's assets. And we can see in the dark red towards the top left of the circle that in 2021, the average household had 41% or 41.7% of their net worth tied up in real estate. So by far the most popular asset class for somebody's investment portfolio is real estate. In fact, if we go back to 2001, we look at that bar chart, it actually shows that 51.9% was the average amount that somebody held in their investment portfolio under real estate, so heavily weighted. So it shows that, you know, Singaporeans like real estate as an asset class, and typically over the years, especially for the I think it's the Medaka generation, they'll have done extremely well. But who knows how things are going to continue depending on some of these next slides. What we can see is that in terms of fertility rates, going back into the 1960s, the reproductive rate was an average of about 6 children per family. Fast track towards today, and it's 1.1. And the threshold that's required to just maintain the Singapore population is 2.1. So it's significantly below what is required to just maintain the population. We can also see in the bottom graph that the average size of the household has also significantly reduced as well. Now, the graph on the left is actually showing over time the population of Singapore, and we've got a couple of arrows whereby the red dotted line is actually showing by 2035 that the Singaporean population, if things stay in the status quo of the fertility rate, that the population, you know, is going to start declining quite significantly. The black line is including Singaporeans as well as immigration of personal PRs, employment pass holders, and so on, which is important, as we can see, to maintain population to support an aging population. Now, the graph on the right is the projected population growth of the UK, or I should say England. And what we can see is a fairly straight line graph showing that a few years ago, the population was just under 56 million. And it's projected by 2042 to go up to 62 million. And if you just crunch those numbers, I mean, we're talking, what's that, about 7 million increase in population. And that's an awful number, a lot of houses that need to be built, considering that there's already a chronic undersupply. Now, in this bar table, I'd like you to focus on the two areas of the age 20 to 64, which is really people of working age, and the next line below, age from 65 and above. And what we can see is that the working age of 20 to 64 years old has been reasonably stable, but it's just showing signs here of starting to reduce in numbers. But a key one is looking at those the number of people that are 65 and older. And we can see in 2005, that was 270,000. Today, though, it's more than double that at over 600,000. And the ratio of working people to effectively retirees has gone from a ratio of 8.1 to 4.3. So there's less working people, more people in their golden years. And again, this is putting fundamental economic strain on government policy. And it's not just Singapore. This is a major issue in many other countries like Japan, Korea, to name but a few. Now, this is a graph that goes back to about 1995, showing the average price of a property in the UK. And if we go to the far bottom left, the average price in 1995 was about £50,000. So that's probably about 85, 90,000 Singapore dollars for the average price of a UK property. Fast track to today, and we are just under £300,000 for the average property. I think the take-home message here is that we can see over a long period of time that the line is pretty straight. The biggest blip that we see in 2008, 2009 was the global financial crisis, where prices of property across the UK on average dropped by about 18%. But when we look at what's happened in the last few years, we can see that the line is actually getting steeper. And as I mentioned before, we've seen one of the fastest growth in terms of property prices since records began. So again, we've broken it down in sections here to also show in a certain time frame what has been the average annualized capital growth in that section of time. So UK house price growth in the last couple of years, so really through the COVID time, the UK saw an average of a 9% capital growth across properties, and last year 7%. So, you know, again, very attractive capital growth. Interesting, we've broken this down by region, and people may be surprised that places like Wales, very rural area generally speaking, the southwest, so for those of you who know the UK, Devon, Cornwall, Somerset, Dorset, generally very rural, beautiful areas of the UK. Northern Ireland, these are the three regions in 2021 that saw the highest capital growth. And if you remember what people were frequently doing, especially in that early stage of COVID, it was a race for space, and people were realizing that I don't necessarily have to be living in the center of the city because it's lockdown. I'm not even able to go to work. And so many people saw themselves relocating to places where they could work from home as long as they had strong internet and a work environment. People were working significantly at home. We have seen very much I call it boomerang effect, where in the UK there has been, as policies were relaxed and people started to work, a strong migration back to the office. But there's also a certain section of the population that are really, I call them hybrid workers, and they are working partly from home, partly from the office. Now, what we did see, and I touched on this right at the beginning, is that in the last quarter was the first time that we'd seen actually negative growth in most of the regions across the UK, for the reasons, again, that I've mentioned earlier in the presentation. Now, this is the private property index for Singapore. And again, we can see very strong numbers, similar, but maybe slightly higher. So in 2021, the average private property increased by 10.6%, and in 2022 by 8.6%. So similar-ish figures to the UK. Now, this is looking at rental inflation, or the increase of rents, and there's quite a lot going on in this graph, but let me ask you to focus on these pink dots, because these pink dots show effectively the 5-year average annual increase of rent as a percentage. So as an example, Hull in the sort of northeast of England, roughly 4%. Somewhere like London, probably a little bit less, 3.5%. So these are the average figures for the different cities across the UK. But when we look at the last year, so 2022, the purple bars are reflecting the annual increase in the rents in these different cities. So if you're a London landlord, it's happy days, because we've seen a phenomenal rebound in the rental market that actually suffered significantly in the early part of COVID. And we've seen, last year, an increase in rents of 17%, which we can see from this bar chart is by far the highest of any city across the UK. One Global focuses very much on London, Manchester, Birmingham, and we can see that all three of those cities have performed very well. And the average across the UK has seen an average increase of rents of 12.1%. Now, here in Singapore, this is the private property rental index, and we can see that for quite some time, rentals were very flat. But then in the early part of 2021, something started to happen. And, we're going through COVID, and there's really been an incredible increase in rentals in the private sector in Singapore, so much so that we're looking at over 40% average rental increase. So, again, I feel for those people on the call today who may be expats or people renting, because you can be renewing your lease and suddenly, going from a 5,000 rental to, it could be 7,000, 8,000, and significant increase. And, what's driving this? Well, again, it's supply demand, but I think Singapore has done a phenomenal job managing the challenges of COVID, and it's benefited from that, whereby a lot of people look to Singapore as a safe haven to live. It's a very popular place for mainland Chinese coming in, driving up property prices, rental prices. What we've seen in Hong Kong with the political changes there, people relocating to the UK. There's something like 390,000 B&O passports, I believe, that were issued for the UK. But Singapore's also been a major benefactor of that. So a lot of wealthy Hong Kongers coming to Singapore, needing to rent somewhere, maybe temporarily, driving up rental prices and property prices as well. Now, this is taken from the URA website just a couple of weeks ago, and it basically shows in this red line here vacancy rate of private property in Singapore. And we can see, again, there's been a tightening of supply, and now we're seeing, almost over the last few years, the lowest vacancy rate at approximately 5.5% vacancy rate. So again, if you're a landlord in Singapore, it's a good time. We've seen rents going up significantly. Now, it's not easy to get data across the whole of the UK for vacancy rates. So our friends at Life Residential, a company that we work very closely with to provide a full service property management in the UK, they manage over 4,800 properties across the UK. A lot of it is in London. And this is actually showing, out of the properties they had, at the time this graph was made, they had approximately 4,000 properties on their books. So what we can see is, as we hit COVID, suddenly, and this is London, I should say, so these properties are in London, COVID hits, and suddenly the lockdowns hit, and people say, well, no point renting in prime central London anymore. I might as well go to the outskirts, or go into the country where the rents are a lot lower and I can be working from home. So we did see vacancy rates go up. And interestingly enough, though, at the worst vacancy rate, 209 vacant properties out of the 4,000 properties that they're managing actually equates to about a 5% vacancy rate. Now, I said in the previous slide that Singapore is at one of its lowest vacancy rates, but it's at actually 5.5%. Now, you can see that as the UK started to relax its COVID restrictions, things quickly changed, and to the point whereby the rentals now in London have actually surpassed what they were pre-COVID. And when we look at these vacancy rates, actually, I got the figures from Life Residential just yesterday over the last few months. The vacancy rate that they have for last month in February was 63 units out of 4,800 units they now manage, which equates to a vacancy rate of about 1.3%. So again, what we're finding in places like London and many of the key UK cities is that people are going to do viewings. If they don't make a decision on the spot, the next day it's gone. And quite often landlords are in a position where they can say, I've got multiple tenants paying me a decent rent. You're actually going to need to pay 6 months, sometimes 12 months rent up front. So things have significantly changed. So as a landlord, you're in a very strong position. If you're a tenant, it really is a very challenging time. Now, this is a forecast from JLL, and I touched on this earlier, is that over the years, I like to look at data and analytics to try best, using the best data that we can get our hands on, to predict and look into the crystal ball of what's going to happen in the future. And I mentioned earlier that in early 2020, as COVID was breaking out, it was estimated by the analysts that the property market in the UK was, the capital growth was actually going to drop between 5 to 7.5%. And we've seen that actually in 2021, it went up by 9%, and 2022, 7%. So again, hugely wrong, and not realizing how something like COVID would impact how people think about the kind of property they want to live in, and rethinking how developers rethinking how they provide property. So properties have gone up, and I mentioned because of interest rates going up, cost of living going up, lack of affordability, less buyers in the market, we're starting to see things change. So at the end of last year, JLL brought out this data, and their forecast was that for this year, the average property increase or decrease would be, in this case, forecasting prices dropping by 6% and then recovering fairly even the next year, and then starting to pick up from 2025 onwards. The rental, we can see, again, decent figures, 4%, followed by 3.5%. In recent, last year, we can see it was well overperforming that. The average was 12.1%. Now, earlier this month, Halifax, a huge building society and also a bank that provides a lot of mortgages in the UK, obviously track very close data. If I just read the point at the bottom, it says house prices across the UK are holding up better than expected. Better than experts had thought, with the latest data suggesting that after a wobbling at the end of last year, they stabilized so far in 2023. So that's the Halifax that was posted on the 7th of March this year. So it's going to be interesting to see. I think most people were expecting the UK to go into a recession. They narrowly missed going to a recession. Analysts, are predicting, in this case from Jones Lang LaSalle, you'll see all sorts of various predictions, but Jones Lang LaSalle predicting a price drop of 6%. The most current data coming from Halifax seems to be showing that prices seem to be holding out and not going down at this point in time. Okay, some other things that have a huge impact on investing in a property in the UK and Singapore. So these are the buyer's stamp duty, the basic rates. So if you're living in the UK and you are buying a property to live in, the stamp duty for anything below 250,000 is 0. It goes then on a sliding scale based on these numbers, 5, 10, 12% on a sliding scale based on the purchase price of the property. Now, for most people on this webinar, I'm assuming that you're not living in the UK, and because we're talking about investment property, something you're not living in, you're going to be investing in and renting out. As a non-resident, you will automatically be charged an additional 2% over and above the rates you see in this table. And if you are renting it out as a buy-to-let property, there is an additional 3%. So in effect, if you're non-resident in the UK and you're buying it as a rental property, you're going to need to put an additional 5% on the figures you see here. So as an example, you buy a property under 250,000, the stamp duty you'll pay is 5%. If you buy a property above 250,000, the portion above 250,000 will be hit with a 5% stamp duty plus another 5% for the non-resident and the buy-to-let. So I hope that's clear. Let's have a look at Singapore. So these are the buyer stamp duties. If we focus on the column here for residential property, the first 180,000 is at 1%, the next is 2%, the next 3%, the next at 500,000 above is 4%, and just recently these new stamp duties have come in. So over 1.5 million, you're looking at 5%, and over 3 million, 6%, on a sliding scale. Now, one of the things that the government has done is bring in a variety of different cooling measures, and one of those has been significant stamp duty costs. So these are the historic ones. So let's focus on what the situation is at the moment. So if you're a Singapore citizen and you're buying your primary residential property, happy days, there is no stamp duty. If you're a Singapore citizen buying a second residential property, you're going to have to pay a 17% stamp duty in addition to the basic rate in this slide. So, you know, on $1 million property, you've probably got a blended average of about 3% stamp duty as the basic stamp duty or buyer stamp duty, plus 17%. So you're probably looking at about 20% stamp duty on a second investment property. As a Singapore citizen on your third, you're going to pay 25% additional buyer stamp duty, plus roughly, let's say, another 3% basic stamp duty, so about 28%. If I jump down to, let's say, a foreigner here. So if you're a foreigner, whether you're living overseas or you're a foreigner on an employment pass here in Singapore, you immediately get whacked with 30% stamp duty plus the basic. So you're probably going to be looking at 33% stamp duty. Why has this been brought in? Because there are a lot of wealthy people in Singapore, there are a lot of wealthy people around the world that want a piece of Singapore. And in order to maintain some level of affordability for Singaporeans to have their primary residence, these are brought in to try and curb wealthy people buying up all the property, and meaning that many of the locals are priced out of the market. Now, in One Global, we have a research arm called One Global Labs. They bring us a lot of data, and they have a great stamp duty table to help us compare between different countries. And so what I've plugged into the chart here is $1 million condo property. And on $1 million property, if it is a Singaporean buying it as their second property, I mentioned earlier, they're going to get hit with about 20% stamp duty. So it actually comes to just under 200,000 stamp duty on a 1 million property if it's your second property. If you were buying in the UK a property with the same value of $1 million Singapore dollars, as a foreign investor, not a local, but as a foreign investor, you'd be paying around about 75,000 Singapore dollars in stamp duty, so significantly less. Now, if we go to a third property, so a Singaporean buy their third property, I mentioned that we're up at about 28% stamp duty, which comes to just over 270,000 in stamp duty on a $1 million property. It doesn't change for a UK property, it'd be about 75,000 Singapore dollars. So again, huge difference. It's a tax which basically goes to the government, and it's almost like your investment is starting at 20 to 30% below par. Now, the next two slides, hang in there. If you've just been to get a coffee, if you've dozed off, I want you to wake up for a moment. There's a lot of numbers here, but the next two slides I think is going to show a very powerful message. And I suppose what I'm trying to share with the audience tonight is that many people, when they invest in a property, it's not uncommon for somebody to say, well, look, I know Singapore or Malaysia, it's close by, I feel comfortable with it, I can easily go and look at it and find it. I can have a friend or an agent manage it. My challenge to that is that just because you can see it, you can touch it, you're more familiar with it, I get it, but does it necessarily mean it is the best place to put your hard-earned dollar? And very often the fear of investing overseas is the fact that I don't really know the market. How do I know it's a good investment? How am I going to get financing? Who's going to do my conveyancing? Who's going to look after and manage my property? So, you know, at One Global, we have provided a complete end-to-end solution so that if you haven't invested overseas, we'd like to build a relationship with you so that you feel comfortable and confident that you can make a well-informed decision of whether you should put your hard-earned cash into a Singapore investment or possibly some other part of the world. In this case, the comparison tonight is between Singapore and the UK. So I'm just going to have a caveat over the next two slides because there are high-level general assumptions, but I think the message will come through as you hang in there with me over the next two slides. So in Singapore, I'm making the assumption, and it's, I think, a reasonable assumption, that an entry-level condominium property, a one-bedroom unit somewhere on the outskirts of Singapore, roughly speaking, $1 million to buy that property. An entry-level condo or apartment, private apartment in the UK, we have properties on our books at the moment at £120,000. Today's exchange rate, that's about 195,000 Singapore dollars if I convert it. So we can see just the entry level is significantly lower in the UK. The stamp duty we've mentioned on a second property is approximately 20%, so that's 200,000 on $1 million. In the UK, if it's below £250,000, which this property is, there's no basic rate. You just pay the 5%, which is a combination of 2% non-resident, 3% as a buy-to-let investment property. So we can see significantly lower percentage of stamp duty. The loan to value in Singapore on a second property for a Singaporean is only 45%, which means you're putting a 55% deposit down. That means on $1 million property, the cash you require is 550,000, plus your stamp duty at 200,000 means the cash that you need to buy $1 million property, and this doesn't even include things like the legal fees, albeit that's a fairly small fee, but roughly speaking, you're going to need 750,000 Singapore dollars to buy one entry-level condominium priced at $1 million. In the UK, it's very realistic to say I can get a 70% loan to value, whether it's your second property, fifth property, 10th property. We don't have the same TDSR, and we don't, the government doesn't put a restriction whereby the loan to value is going down in this case to say just 45%. As I mentioned, there's no TDSR. Rental yields, I feel like I've been reasonably generous, but in Singapore, gross rental yields on a residential property at about 3%. We're finding in the UK rental, as I mentioned, is very strong at the moment, and 6% is very realistic outside of London, especially in cities like Birmingham, Manchester. We're seeing very strong yields at the moment. When I looked at the estimated rental, the gross at 3,500, take off maintenance fees, similar thing in the UK. Obviously, this is a a much cheaper property. It's not going to necessarily command the same rental as a $1 million property. And looking at about £975, netting after the service charge at about dollars. I'm just converting everything into Sing dollars so we can make more of an apple-to-apple direct comparison. Private property vacancy rate, I've mentioned in Singapore, is at 5.5%. London, in fact, other cities like Manchester and Birmingham have been even lower, at closer to 1%. Mortgage terms I've done over 25 years using the interest rates that are there or thereabouts. Mortgage monthly repayments on both those properties, giving you a net cash flow on a $1 million property of about positive $650 a month for the Singapore property. And for one entry-level condo in the UK, about $131. Now, something I want you to focus on is this figure here of 750,000 of cash for one property, and basically because of the loan to value and the ticket price of the property being so much cheaper, the amount of cash that I would need on a 70% loan to value and the stamp duty is only $58,500 to buy this $195,000 property in the UK. So here's the question: with 750,000 Singapore dollars, how many of these entry-level units could I buy with the same amount of cash? So if I put 750,000 into multiple UK properties, how many could I buy? So let's have a look at the next slide. So I did a calculation whereby the same amount of cash, roughly you can see here, 750,000 is how much we need for one property entry-level in Singapore. I could buy 11 units for roughly the same amount of cash because of the loan to value, because of the entry level of the price. Now, 11 units would be generating me, if I take exactly the same amount of income that the previous was showing at $131 per property. If I take 131 and I times that by 11, I get 1,441. We've mentioned already that the one property in Singapore is 650,000. So I'm getting more cash flow for the same amount of money that I've invested into 11 properties. Now, this is a very sweeping generalization, I appreciate, but I'm making the assumption that in 10 years' time, the properties in Singapore and the UK double in price. So I bought it for $1 million. Basically, I'm selling for $2 million. I bought basically 11 units with a combined value of $2,145,000. That's doubled. So it's $4,290,000. Without going into every single figure, I don't want you to fall asleep. As I calculate the capital growth on the 11 units compared with the one condo, the positive cash flow that we've generated from the rental, I then minus off some of the expenses in terms of repaying back the mortgage loan, or rather the outstanding loan that needs to be paid back to the bank. I've calculated one of the benefits of Singapore is that there is no capital gains tax. There is in the UK, and if you buy through a company structure, that can potentially be slightly lower. But the bottom line profits on these assumptions is that you're making a net profit on your Singapore property of just over $1 million, and on the UK 11 units, you're making just under 1.8 million. And when we look at the ROI, the amount that we've invested, how much cash did we invest? Roughly 750,000 in both of these opportunities. But my ROI on the Singapore property is 141%, and my ROI in the UK 11 properties is 239. So a significantly higher rate of return. I think in addition to that, I would always feel from an advisory perspective is that having 11 properties and diversifying into a portfolio is far less risky than having all of your eggs in one basket in Singapore. So if one of the properties in the UK for some reason had an extended void period, maybe there was a significant repair and maintenance, so for a few months it's not rented out, you have 10 other properties that are generating you a very strong income. If you had a void period in your one property in Singapore, or a major repair and maintenance issue, you could be going several months with absolutely no income with a significant mortgage to service. So I hope that, these numbers, albeit, using very crude assumptions, just share and demonstrate a very powerful point of saying, well, look, this is my hard-earned cash. Where would be the best place, if I like real estate as an asset class, to maximize my returns? And really what I'd like to encourage is that for those people who, in this case, may not be so familiar with the UK, come and see me, come and see our team. We're a very experienced team at One Global. Make sure that you understand the dynamics of the property market, build up trust. I hope I'm building some level of trust with you tonight and credibility. And, I'll be delighted to answer any of the questions that you have. Now, we're pretty much at the end, but what I wanted to do, this isn't a webinar that is project selling. It's very much about educating and making this comparison. But let's actually put this into perspective, because I've been saying about, the entry-level property prices in the UK are significantly lower. So I've got 3 scenarios here. This is a property that we're about to launch. There's a phase that's already been launched. It's called Hayes Village, and it's in London. It's not prime central London. It's actually zone 5, but it sits literally within a 9-minute walk of the Elizabeth line, the high-speed rail, which allows you to connect into central London in about 20 minutes. And its connectivity is so good is that you could be living in zone 2 and paying 2 or 3 times the price for a property, and it taking you still the same amount of time to get into the city centre. Now, at an entry-level price point for a 1-bedroom unit at £336,000, again, if you were leveraging a mortgage at 70% loan to value, for the same amount of cash, you could buy 3 or possibly 4 of these properties in London. It's a 999-year lease, estimated to complete in Q2 of 2024, albeit in this project there are some completed units, with estimated rental yields of 5.5%. Birmingham, I think one of the best cities in the UK in terms of a strong investment case. We have a project here called Transport Works, and the entry-level price is £120,000, which is actually what I used in my previous illustration as an entry-level property in the UK. It's also 999-year lease, estimated to complete in Q4 of this year, and has estimated rental yields of between 6 to 12%. And I'll just break that down. It's estimated to have a 6% yield if you were looking to have a long-term lease, that is a tenancy agreement for, say, 12 months or more. However, this property has a quite unusual clause in it that allows it to have short-term lets, so the kind of lets that Airbnb do, and with a decent occupancy rate, it's projected that those yields could increase to 10 to 12%. Another project which is very interesting in Middlesbrough, the far right-hand one, is a UK social housing investment. And these start from just as little as £90,000, which here in Singapore, you could hardly buy the front door of an apartment for that. And I think a lot of Singaporeans, when I speak to them, just quite shocked that you can actually buy an apartment, albeit a small studio, this kind of price. Interesting thing with the UK government-backed social housing is that these leases offer anywhere between 7 to 9% net yields. There is a housing association, which is the equivalent of a property management company that's appointed by the government. The housing association gets paid by the government. The housing association pays the rent directly to you, the landlord. They basically provide property management services. You don't get charged for that. They do the repair and maintenance. And you buy the property with a 5-year rolling lease in place. And effectively, there are no void periods. So it's a very low risk, low entry level, high-yielding property where the rental is adjusted every single year based on inflation. So there's just a flavor of some entry-level properties in different cities across the UK to give you some indication of actual properties that are on sale right now if you were looking for entry-level properties in these different cities across the UK. So that brings me to the end of the presentation tonight. I hope that I haven't overwhelmed you with too much data, but I hope that the data has given you food for thought. I hope looking at this comparison, it's opened up your eyes. And I would always advocate to somebody that if you're living in Singapore and you are Singaporean PR, and this is where you see yourself living long term, having your primary residence and buying your property here in Singapore would be a very wise choice. I do that myself. But I would question, unless there are very strong reasons about when it comes to a second property, where would be a wise place to put your hard-earned cash? Would it be putting it into a single property in Singapore, or using the same amount of cash, investing potentially in a portfolio of properties, spreading your risk, getting higher yields, and ultimately a much higher ROI. So that wraps up the presentation for tonight. We've done just about an hour. What I'd like to do is encourage people to enter questions into the chat box. So if you can put your questions into the chat box, and I'll be delighted to help. I appreciate some people may be having to move on. It's just gone 9 o'clock, so I appreciate your time. If you have any questions, you can see my contact telephone number and email address hopefully on the slide there, and please feel free to either give me a call or an email. If I haven't addressed your question tonight, then I'll do my best to address that over the next few days. So thank you very much. And what I'm going to do is start going through some of the questions here and see if I can answer those. And if I can't answer them, I've got plenty of very experienced people at One Global who I can almost certainly get the answer from. So I haven't looked at the questions in advance, so I hope I don't miss too much. But Pearl's got a question here. Does this example for UK property monthly mortgage payment only paying interest? So the answer is yes. So as an investment property, most clients, if there's an option to go for an interest-only mortgage, generally take it because the amount that they're servicing each month is a lot smaller. They get more cash each month, and then they're in control of how they wish to use that cash, whether they decide at the end of the year to do a lump sum down payment of their mortgage, or maybe they use it for another investment. It really is up to them. So, okay, Smitty here. Can you share the per unit per square foot comparison for London versus Singapore for similarly located properties? I mean, right off the top of my head, I mean, in prime central London, you can easily be talking anywhere from £2,000 to £4,000 per square foot. In prime central Singapore, you'd be safe to say that, $4,000 to $5,000 Singapore dollars per square foot as a gauge or a guideline. 11 properties versus, so this is James. 11 properties versus one property, which is easier to manage? Good question. And how about using CPF in Singapore? CPF is a wonderful thing, and many people do use CPF to be able to service their mortgage. Bear in mind that if you are servicing your mortgage with CPF, effectively it's like lending money to yourself, and when you sell the property, you do need to make sure that when you sell it, not only do you pay back the outstanding loan, but you have to pay back yourself the interest that has accrued over time as well. So it's important to bear that in mind. But it does mean that you can use your CPF to service your mortgage. Many people, the biggest outgoing that they have and the biggest purchase they might ever make in their life. Which is easier to manage, one property or 11 properties? Good question. I think it would be fair to say that managing one property compared with 11 properties would be easier. I suppose you have to make that decision then. You know, do I want to put all my eggs in one basket and have one property, less headaches in terms of management, or if I have a good property management agent in place, can they do a good job so that, again, they can manage my portfolio? Again, it's a good question. How is rental income taxed in the UK? Okay, so I'm not a tax advisor. I'm not licensed to give tax, but basically in the UK, you have income tax thresholds. So it goes at 20% for a certain threshold, which is roughly the first £38,000 of income there or thereabouts is at 20%. The next tier goes up to then 40%, and the highest tier, I think, is now £150,000 and above. I believe that's about 45%. There have been some movements on that, and again, don't quote me, but there or thereabouts. So if you are a property owner and you are getting an income, then there will be an income tax liability. Now, there are various ways and structures that you can acquire the property. It could be in your personal name, but through a company structure, this can allow you to offset some of the costs related to the property to reduce your income liability and overall reduce your tax in that respect. Okay, David, a new and secondary market property, how do we check which is more better to buy? Does your company provide any valuation and analysis on this? We don't personally do valuations, but it's a good question. Should I buy in the primary market, that's a new build property straight from the developer, or should I go into the secondary market? I think, again, it's important to work with somebody that you trust and feel comfortable with. Going into the secondary market, especially if you're going into less well-known areas, I think it's very important to have local knowledge and good advice. And then, of course, if it's a it's a secondary property, how old is it? You know, how much, and you can get not just a valuation, but you can have a survey done to ascertain how much repair works might need to be done. If the whole place needs to be rewired, that could be thousands of pounds that needs to be spent. So dare I say, and again, it's a very high level generalization, buying a new build property from a reputable developer, and that's a key point, tends to be less risky than buying an older property that may have some skeletons, so to speak, in the closet, and suddenly you're paying a lot of repair and maintenance. And if you buy into an area that, let's say, doesn't have the same drivers for rental demand, you know, can you rent that out? Are there plenty of tenants? What are the employment areas around that area? What is driving the property capital growth and rental growth? Okay. All right, Amanda, can we get financing loans in the UK to buy these properties as foreigners? The answer is, generally speaking, yes, but like any bank, they will need to do their own profiling and due diligence as a client. So a mortgage broker can help prepare a mortgage application form. There's no guarantee that you'll get a mortgage, but a mortgage broker will be able to understand your financial position, give you feedback of whether you would be, in theory, eligible for a mortgage, and help you prepare a mortgage application form to maximize your chances of being able to get a mortgage. But in theory, an overseas, somebody residing in Singapore or outside of the UK, in theory, can apply for a mortgage and be given a mortgage. Okay, sorry, there's lots of questions coming in, and I'm hoping I'm not missing or jumping them, but David, can you tell us more on how and what to buy property using and what is the using, I don't know, using co, and what is the cost, including annual cost for this? You mentioned that you can get property at a fraction of its cost. I'd be interested to learn more. I'm not quite sure what you're getting at, but certainly when it comes to entry-level property prices, depending where you are in the UK, they can be significantly lower, as I've shown in the UK. You can go the other extreme in prime central London, and the prices of these properties, you know, are extremely expensive and comparable to prime central Singapore. Raymond, best structure is UK or offshore company to hold the portfolio. Okay. We're getting into sort of tax planning and structuring. What I would suggest again is I'm not licensed to give this kind of advice, and it really does depend on the kind of portfolio you have. There are different structures. A company that I've used very closely, if somebody's buying 1 or 2 properties and has a small portfolio, have a very attractive way to and a very affordable way to buy property through a company structure. If you are building a portfolio roughly, let's say, of £1 million or more, there can be other structures. So again, it's very difficult for me to answer that in a webinar. It really needs time to sit down with you, understand yourself as a client, what you have as a portfolio now, where you see yourself building a portfolio with a view of how can we then give you the right advice to structure it right from the get-go. Pearl, does buy-to-let loan look at your annual salary, income, as residential loan are roughly 4.5 times annual income? Can you live in a buy-to-let loan property? Well, if it's a buy-to-let property, you couldn't live in it because you're renting it out to somebody else. It's an investment property. I think we've spoken about this actually on a offline basis, Pearl, but banks will evaluate different clients and provide mortgages based on different criteria. The standard way is to look at your financial profile. They're going to look at your income, your expenses, and your liabilities. It's a bit like a balance sheet. So they're going to look at you and look at your ability to service the mortgage. But there are other lenders that will look at the ability of that property to generate income. And so for some lenders, they will say, well, how much rental are you going to generate? How much is the mortgage and the outgoings? And will the rental equal or surpass the outgoings? They may have a margin saying we need a buffer so that you need at least 20% more rental income than your outgoings, and they may assess a mortgage on that. So there are a variety of ways. And again, I know I've put you in touch with a mortgage broker. Again, when it comes to questions in a specialist area, I do webinars on that very subject. So it's tough to answer all questions tonight, but again, what I'd be more than happy to do is follow up with you so I can bring in some of my colleagues to give you the right advice. Spiddy, I think question was on company structure. Yes, so as I mentioned before, there are ways to buy and invest in property through a company structure that's been made much more commercially affordable at about 1/10 of the price it used to cost. It's digitized through a platform base, and once you've been on board as a client, you can have your shareholding agreements set up literally in about 15 minutes. They will open up a bank account for you for your income and outgoing expenses. They will do the tax returns and a whole variety of other services. And potentially, depending on, again, yourself as a client, your personal circumstances, it may be more tax efficient to buy through a company structure. Which is the second most popular city in the UK to invest besides London? What about Scotland? Okay. I don't have a specific number, but what I would say, just having worked in this industry a great deal, is what we've seen really over the last 10 years is that after London, I would say there's been a huge amount of interest in Manchester. It's a city that has transformed from when I was a young boy, like many of the northern cities, going through huge regeneration. And so if you had to ask one city, I would say Manchester. And quickly following behind that is probably Birmingham. And both of them have very strong investment cases. Now, when we look at Manchester, if we look at prime central Manchester, property prices have gone up significantly, whereby prime central Manchester, the Deansgate central area, you can easily now be talking £500 per square foot and above, which is the equivalent of the price of property in the outskirts of London. Birmingham is certainly catching up as well. Prime central Birmingham now, you're talking really between £400 to £500 per square foot, and even some of them in the jewellery quarter can be even higher. What about Scotland? I must say I'm not an absolute expert in Scotland. I mean, Edinburgh has certainly seen strong growth over the years. Glasgow has had very strong rental yields. Again, in this kind of webinar, I'm giving some high-level feedback, but when it comes to recommending an investment, again, it goes back to knowing the client, understanding your circumstances, what it is you want to achieve, what is your risk appetite, and personalizing the right. Okay. All right. I'm just going to backtrack see if I've missed a few questions. Okay. Okay. Amanda's asking about vacant properties. Are they mainly the commercial properties? No, this the figures that I was giving in the presentation are all residential properties. David's asking, London is equal to Tokyo. So when you talk of UK property, which city would you equate to Osaka? The second most popular city in Japan, and what is your take in terms of capital growth compared to London? I'm not an expert in Japan. I'm not an expert in all countries around the world that have been possible to do so. You know, I do know that the yen recently was very weak, making it just from a currency play very attractive. And you know, Tokyo has done very well. I think really when you look at Osaka, it really is known as the second city in Japan. And if I was likening that to a second city in the UK, I would, I suppose, compare it with something like a Birmingham or a Manchester. Okay. Gaurav, can we forecast a good rental growth in the UK market, considering factors such as a rise in interest rates and Brexit? So I hope this came through in the presentation. I noticed the question was asked fairly early on, so I think I've addressed that at the moment, the rental market is probably as strong and as buoyant that I've ever known in my lifetime. So at the moment, rentals are just going up and up and up because of the undersupply of rental property. Right, I think I've addressed that one. Okay. All right. Okay, I think we've addressed the questions there. If I've missed any questions, I do apologize. You've got my contact details. I hope you can still see that on the screen. So please do feel free to WhatsApp, call me, or email me, and I'll be delighted to answer the questions. But really what I'd like to do is events like this hopefully give an opportunity to kind of get to know each other and understand a little bit more about different markets, but there's still no substitute to meeting you face to face or through a Zoom call and really personalizing a valued service, so that ultimately, before I even discuss about a property solution, let me understand you as a client, so that I can ensure that, you know, I'm providing you with the best possible advice. And the better I can understand you as a client and your investment goals, the easier it is to advise me. So let's spend some quality time together. This is obviously a large group of people, and I appreciate taking time out of your busy schedules to attend tonight. I do hope that you found it insightful and useful, and potentially, if you haven't considered investing overseas before, it may be an eye-opener and something that you'd like to look into in more detail. So thank you very, very much. I do regular seminars and webinars, so we'll be delighted again seeing you in the future, and look forward to either meeting you or seeing you in future webinars. So thank you and good night.